Life is a journey filled with beautiful plans and unexpected turns. You work hard to build a future for your family, to provide for their education, and to create a home filled with love and security. But have you ever paused to think about what would happen to those dreams if you were no longer there to see them through? This is not a pleasant thought, but it is a necessary one. Life insurance is the answer to that difficult question. It is a powerful promise you make to your loved ones, a contract that ensures their financial stability even in your absence. You consistently pay a small amount, called a premium, to an insurance company. In return, the company promises to pay a much larger pre-agreed sum of money to your family if you pass away during the policy's duration. This payment, known as the death benefit, acts as an immediate financial shield for your dependents. Imagine the weight of home loan EMIs, car payments, school fees, daily household expenses. The money from a life insurance policy can lift that weight, allowing them the space to mourn without the added stress of financial crisis. It is not about putting a price on your life. It is about protecting the value of the life you have built for the people you care about most. This single financial tool can be the difference between your family maintaining their standard of living and facing a future of uncertainty and hardship. Think of life insurance as a financial safety net, carefully woven to catch your family if the unthinkable happens. It is a selfless act of love and a cornerstone of responsible financial planning. The person you designate to receive this money, your nominee, will have the resources to navigate the difficult road ahead. This could mean paying off the mortgage on the family home, ensuring your children can still pursue their dreams of higher education, or simply covering day-to-day living costs until they can find their footing. It is a plan for continuity, a way to ensure that your financial responsibilities are met and your family's future remains secure. The peace of mind that comes with this protection is immeasurable. Knowing that you have taken a definitive step to safeguard your family's well-being allows you to live more freely and focus on creating memories today. It is a conversation every breadwinner should have, not just with themselves, but with their partners. The process begins with understanding the different types of promises available. In India, the landscape of life insurance is broadly divided into two main paths, one focused purely on protection, another that combines this protection with a savings component. Understanding the distinction between these two is the first critical step toward making a smart, informed decision that aligns perfectly with your family's unique needs and your financial goals. The first and most fundamental type of life insurance is called term insurance. Its beauty lies in its simplicity, its singular, powerful purpose, to provide pure financial protection. Think of it like renting a safety net for a specific period. You choose a term, the length of coverage, 10 years, 20 years, 30 years. You pay a fixed premium throughout this term. If you pass away during the chosen period, the insurer pays the full death benefit, the sum assured, to your nominee. That payout is tax-free under current laws. It provides a substantial financial cushion for your family when they need it most. The defining feature: what happens if you outlive the policy? If you survive the full term, the policy simply expires. There is no payout. You do not get your premiums back, just like car insurance after a safe year. This is why term insurance is affordable. The insurer only pays if death occurs during the term, lower risk for them, which means significantly lower premiums for you. Affordability lets you secure large coverage at small cost. Example, a healthy 30-year-old in India could get a sum assured of 1 crore, 10 million rupees, for a 30-year term. Annual premium could be as low as Rs. $12,000 or Rs. 15,000, depending on health and lifestyle. If they pass away at 45, the family gets the full 1 crore. Pay off home loan, 40 lakhs. Set aside 30 lakhs for education. Use 30 lakhs to generate income for daily expenses. Term insurance makes this accessible to almost everyone. Sole objective: replace your income. Cover your financial liabilities. It is not an investment. It is not a savings plan. It does not build cash value. It does not offer returns. Its role is strictly protective, efficient and cost-effective for dependents. Ideal for young parents, new homeowners, anyone who wants to ensure their family can maintain lifestyle and long-term goals. Protection in its purest, most unadulterated form. On the other side of the insurance spectrum are traditional life insurance plans. These policies are designed to serve a dual purpose. They provide a death benefit for protection, while also incorporating a savings or investment component. This category includes several types of plans, such as endowment policies, money-back plans, unit-linked insurance plans, or ULIPs. Unlike term insurance, these plans promise a payout not only in the event of death, but also if you survive the policy term. This payout at the end of the term is known as the maturity benefit, which makes these plans appealing to individuals who want to get something back for the premiums they have paid over the years. The mechanics of a traditional plan, like an endowment policy, are straightforward. You pay a significantly higher premium compared to a term plan for the same amount of life cover. A portion of this premium goes toward providing the death benefit. The remaining larger portion is invested by the insurance company. Over the policy term, this investment grows often with guaranteed additions or bonuses declared by the insurer. If you pass away during the term, your nominee receives the sum assured plus any accumulated bonuses. If you survive until the policy matures, you receive the sum assured along with all the accumulated bonuses as a lump sum maturity benefit. These plans are often marketed as a disciplined way to save for long-term goals, like a child's wedding, retirement, funding a major purchase. Because a portion of your money is being saved and grown, they feel less like a pure expense and more like a forced savings vehicle. For people who struggle with saving independently, the regular premium payments can instill a sense of financial discipline. Furthermore, many of these policies offer the facility to take a loan against the policy's accumulated cash value, which can provide a source of liquidity during a financial emergency without having to surrender the policy entirely. This blend of protection, savings, and accessibility makes them a popular choice. However, it is crucial to understand the trade-offs. The higher premiums mean that for the same budget, you will get a much lower life cover compared to a term plan. For instance, the same annual premium that might buy you a 1 crore term plan could perhaps only secure a 10 lakh endowment plan. While you do get a maturity benefit, the returns on these traditional plans are often modest, typically ranging from 4% to 6%, which may not even keep pace with inflation over the long term. Unit-linked insurance plans, ULIPs, are slightly different. They link the investment portion to market performance, offering potentially higher returns, but also carrying market risk. To truly grasp the difference, let's place term insurance and traditional plans side by side and compare them across key parameters. The most fundamental difference lies in their core purpose. A term insurance plan is built for one reason only: pure, unadulterated protection. Its job is to provide the maximum possible death benefit to your family for the lowest possible cost. In stark contrast, a traditional life insurance plan, like an endowment money-back policy, is designed to serve two masters. It aims to provide both protection in the form of a death benefit and a savings vehicle that offers a return on your investment upon maturity. This dual objective is the source of all their other differences. This divergence in purpose directly impacts the payout structure. With a term plan, the payout is straightforward. The insurer pays the sum assured only if the policyholder dies within the policy term. There is no benefit if you survive. A traditional plan, however, pays out in either scenario. Your nominee receives the death benefit if you pass away during the term. You personally receive the maturity benefit if you live to the end of the policy term. This promise of a maturity payout is a significant psychological draw for many buyers. It feels like they are guaranteed to get their money back, and then some. Naturally, this difference in payout structure leads to a vast disparity in premiums, because term insurance only pays in one, less probable scenario: death within the term. The premiums are exceptionally low. This allows a person on a modest budget to secure a very high sum assured. Traditional plans, guaranteeing a payout one way or another, must charge much higher premiums to fund both the life cover and the savings component. For the same annual premium, a term plan might offer 10 to 20 times more coverage than a traditional plan, a critical factor for someone protecting their family from large financial liabilities like a home loan. A traditional plan offers returns, but these are typically conservative and may not offer significant wealth creation over the long run, especially after accounting for inflation. ULIPs offer the potential for higher, market-linked returns, but this comes with investment risk. In terms of flexibility, term plans are simple and rigid. Traditional plans, on the other hand, sometimes offer features like taking loans against the policy, which adds a layer of liquidity that term plans lack. So, with these two distinct paths before you, which one should you choose? The answer isn't about which policy is universally better, it's which one fits your financial goal. Assess your primary objective honestly. If your main goal is to secure your family's financial future and replace your income if you're gone, the choice is clear. Choose a term insurance plan. It's the most efficient, cost-effective tool for pure protection. It offers the highest coverage for the lowest premium. For pure protection, nothing beats term insurance. Think of it as the foundation of your financial safety plan. A substantial term cover ensures your dependents can pay off all debts. It lets them fund long-term goals like education. It helps them maintain their current lifestyle without compromise. You can enhance protection with riders, optional add-ons, critical illness cover, accidental death benefit, waiver of premium. On the other hand, if you want life protection plus disciplined, long-term savings, and you accept a lower life cover and modest returns for a single product, consider a traditional plan. These suit risk-averse people who want a guaranteed maturity amount, or those who need enforced discipline via regular premium payments. A savvy approach is often to separate protection and savings. Many experts suggest buying adequate term cover and investing the premium difference in other instruments like mutual funds. Public Provident Fund, PPF. Before deciding, review your personal needs. Calculate cover by considering outstanding loans. Consider your family's annual expenses. Consider future financial goals. Today is 2025, 10/13. There's no better time to act. Compare plans from different insurers. Check their claim settlement ratio. Read the policy documents carefully. Whether you pick term or traditional, the key is to act.